afternoon, everyone. Welcome to the May Market Strategy Update. My name is Keith Duran. I'm the Senior Vice President of Business Development at Lear Investment Management. And of course, I'm joined today by Jim Warner, who is the Head of Research and Co-Portfolio Manager. Thank you on behalf of everyone at the company for taking time out of your day to join us. We hope that you find this information impactful, and of course, we do welcome any feedback as well. So feel free to let us know what you'd like to see out of these webinars. For the benefit of several first-time attendees, I'd like to take a second just to talk about what we consider one of the most important differentiators as an investment firm, and that is communication. Communication that is both timely and relevant. You know, advisors rely on us to provide timely communication that you can share with clients. And this is one of the primary benefits that comes out of having proprietary research that is in-house. And it's not to say that we don't use outside research, which we do, mostly to find consensus. But Jim and his team, because of this in-house research, really allows us to collect data and then publish commentary faster than other firms. So, you know, for example, when the Silicon Valley Bank failure occurred, which was on Friday, March 10th, we had distributed our first analysis of that situation on Monday, the 13th. And then we followed up with additional commentary a week later, which was called Crisis Averted, but Economic Questions Increased. Both pieces were written by Jim and can be found on our app, where we post all of our commentary and much more. But communication that is relevant is equally as important. And relevance to us means, how does our commentary relate to what's in the portfolio? Not just, you know, a data dump. The real benefit to these monthly strategy webinars is to learn how market and economic factors affect what clients own. That is, because we only have 30 securities in the portfolio, it enables investors to know exactly why they own each position and then the role it plays in the portfolio based on the secular themes that drive our investment process. So, two things before we jump into the call. One, all of our communication is approved for use with clients. So pending compliance on this webinar, we will distribute once that's complete. And then lastly, during the call, there is a Q&A button at the bottom of the screen. Please, we encourage as many questions as you can, and we will address those at the end of the presentation. So at this time, I will turn it over to Jim Warner.
Great, thank you, Keith. I am going to share my screen with you all so you can see our presentation. All right, should have come up. Terrific. Well, good morning to you all, and thank you for joining me for another installment of our monthly strategy update. This month's presentation is entitled, "It's So Hard to Be Patient." If you can recall, our mantra for investing in 2023 was "Be patient." We chose this mantra because inflation was still high, but declining. Interest rates were getting close to peaking, but the economy was slowing, and there was no way of knowing with precision when the economy would bridge to consistent economic growth. In other words, we're in this stage of moving to the next cycle. We just haven't gotten there yet, and we may have a recession to get through before we get there. So one of the reasons it's so hard to be patient is that our brains are wired to fear and greed. Being patient means controlling these emotions. So while it's easy to look at the NASDAQ's 17% gain this year and wonder why your portfolio isn't up more, the NASDAQ is still 24% below its peak. In fact, the S&P, the Dow, and the NASDAQ, despite all of the intervening volatility, are essentially flat over the last year. The mixture of declining inflation and a strong labor market, combined with higher interest rates and a slowing economy, has led to a series of pullbacks and rallies. We really just haven't made much traction. If we just look at the S&P 500's performance year to date, which is approximately 9%, it's an impressive move. However, as I pointed out last month, it's entirely driven by 6 technology companies. And these 6 companies are up a whopping 34.5% this year and now trade at pretty lofty valuations. As for the other 494 stocks in the index, they're barely up for the year. This radical relative performance creates a very frustrating environment for investors, as you cannot construct a portfolio out of just 6 stocks, even if you pick the right 6 stocks. But greed is a very powerful emotion, and chasing it over the short run is dangerous. One of the reasons why these large cap tech stocks are working so well this year is that they are sensitive to interest rates. Rate hikes last year were kryptonite for these stocks. And with the Fed near the end of the hiking cycle, investors are jumping back in, at least for now. The Fed meets today, and the market expects a final quarter-point hike. Given the recent bank turmoil and many signs of disinflation and slowing economic growth, I expect Chair Powell to press the pause button and wait to see just how much damage higher interest rates are having on the economy, and as they work their way through, as there is a bit of a lag effect. The Fed funds market then shows a pivot, as you can see here, to cutting rates as the year progresses, indicating that economic growth will slow to the point of requiring some help. Not a lot, just 75 basis points worth of help. I showed this slide last month, and I think it does a good job of expressing our view on the chances of recession. To reiterate what I said then and what I've been saying over the last year, we think that various parts of the economy have experienced a rolling set of recessions. Housing was the first, for example, to fall into recession early last year as housing affordability dropped to the worst levels recorded. And interestingly, the home builders ETF, the XHB, is up over 17% this year, which could indicate that this part of the economy may actually be coming out of recession already. But the key thing that we're monitoring is the much larger services sector, which continues to be very, very strong, at least for now. 2 common surveys we look to for getting a sense of the health of the services and manufacturing sectors of the economy is from the Institute of Supply Management, or ISM. As you can see from the graphs, the manufacturing sectors of the economy have been contracting for a year. Recall, a reading of sub 50 means activity is declining. Meanwhile, the services sector has hung in there and it still shows some signs of growth. If we pull back and look at a longer time period, the ISM Manufacturing Index is near a level that I'd call a shallow recession. But the ISM Services Index, if we pull back, is still over 50 and really nowhere close to previous recessionary levels. So these 2 data points will be worth monitoring very, very closely over the coming months. So if we pull back even further and think about GDP, first quarter 2023 GDP came in weaker than expected at a positive 1.1%. And as you can see from the left graph, that this is the 3rd consecutive quarter of decelerating growth. I added the Conference Board's forecast for the next 3 quarters, and you can see that they expect a technical recession for now, so 2 quarters in a row that are negative. However, the Atlanta Fed's real-time GDP now projection is actually plus 1.8% for this next quarter, not negative 1.8 according to the Conference Board. So nobody really knows. But what we can plainly see from the graph on the right is that nominal GDP shows really no signs of weakness. Growth is slowing. That's the line on the graph. It's moving down and to the right, but it's not negative. As we all know by now, the key to the economy's strength, even in spite of high inflation and higher interest rates, has been the strength of the labor market. The unemployment rate remains at historical record lows, but as you can see, continuing claims, the chart on the right here, continue to creep up. Continuing claims for unemployment insurance today are now slightly above the average for 2019. And I point that out because 2019 was a very strong labor market. So it's creeping up gradually. But this is a positive thing in a way, because this data plays right into the hands of the Fed's desire to see the job market weaken so as to alleviate wage inflation pressure. So now, while the economy is slowing, so is inflation, and that is a very good thing. In fact, it's likely falling faster than the CPI and core PCE indicate, which makes me optimistic. This graph is from a company called Trueflation, which provides a real-time assessment of inflation by monitoring over 10 million data points. As you can see, they judge inflation today to be under 4%. If true, this makes me incrementally more bullish on the economy and the markets, because lower inflation supports consumer confidence and, of course, consumer spending. And we can see it in the still healthy personal consumption expenditures. And interestingly, if you look at the chart on the right, personal saving is back on an upward trend, which means, oops, sorry about that. Which means that people aren't having to tap into their savings to continue this spending. They're actually able to add to their savings. It seems to me that this is pretty clear evidence also that inflation is coming down. Just think about where gasoline and food prices were a year ago at this time. All right, so all of these macro data points ultimately play a role in corporate earnings. And the S&P 500's estimates have made some progress towards pricing in a recession, as estimates have declined from $219 per share down from a peak of $230. That's about a 5% decline from peak expectations last year. But when compared to 2022, 2023's estimates now reflect just a 2% decline year over year, which is a far cry from the more typical 15% decline one expects to see in a recession. So if a full-blown recession occurs, estimates may have a lot further to fall. And as far as 2024's estimates are concerned, the market expects a strong earnings recovery to $241 per share, reflecting 10% growth year over year. I think there's a lot of risk to this number, so we're treating this number with a healthy dose of skepticism. Another sign that the equity market is overvalued is to check back with the Fed model. The Fed model compares the S&P's earnings yield with the inverse, which is the inverse of its PE, to the yield on the 10-year Treasury bond. The graph here tracks the spread between these two yields. And you can see that on a relative basis, the S&P is relatively overvalued by a lot. To us, this doesn't mean there aren't stocks worth owning. Like I said at the beginning, there are just a handful of stocks that are driving up the S&P's valuation. So to recap, we have a decelerating economy, a potentially overvalued equity market at the index level, but inflation may be lower than expected, and the Fed may be done after this move. With this context, we're focused on three critical questions. And the first one is, has the Fed raised interest rates to levels that will cause a broader, deeper recession? And the short answer to this is nobody knows. Nobody knows, and that's one of the things that we're monitoring very closely, is to see if we start to see weakness come through in aggregate demand. The second question is, will the banking turmoil tighten lending conditions to a level that impacts economic growth in a material way, in a materially negative way? The answer to this question is reasonably easy to monitor on a weekly basis through the Fed's H.8 data they publish. But with nearly all the banks having reported, it seems that there was a little pause in March during the whole Silicon Valley banking crisis, but then lending resumed. The biggest banks, the B of A's, JP Morgan's, Wells Fargo's of the world, are fine and have very low loan to deposit ratios, implying that they have plenty of capacity to lend. So to the extent that any pullback in lending does occur, and this would be more acute at the smaller regional banks, the big banks should be able to offset that. But again, time will tell. The third question, which I know is probably on everybody's mind, is regarding the debt limit. And yes, 2 days ago, President Biden finally agreed to negotiate with Speaker McCarthy, which is an important first step. And it would appear that this came on the behest of, excuse me, at the behest of very influential donors, and also which includes the Business Roundtable and the Chamber of Commerce. So with the adults now involved, we should get an agreement. But the bid and the ask are very far apart. For instance, the House bill passed last week by Republicans calls for $3 trillion of spending cuts. The White House has said no cuts. The rumor is that the zone of agreement among staffers is $300 to $500 billion. So there's a lot of horse trading that needs to be done. The Treasury announced 2 nights ago, I guess, they will run out of money on June 1st. So that's the approximate finishing line. And like most things in Washington, I would expect a very noisy, highly politicized process to commence and likely not finish until the very last minute. At the end of the day, a deal will get done. Neither side can afford to have grandma wondering where her Social Security check is. It would be political suicide. But the situation could get very ugly in the meantime. The market has historically largely ignored this debate because of the mutually assured destruction a default will create. Nevertheless, if we were to get to that point and have a big D default, all assets would get crushed. There would be very few places to hide. However, just like, if you recall, just like what happened after the first TARP vote failed and the market collapsed the next day, magically the next day, the next vote succeeded and the market recovered. Because don't forget, Congress people have investment portfolios too. So I view any volatility related to this issue as temporary. But because we don't know the answers to a lot of these questions, we still think it's very prudent to be conservative in one's portfolio. So with that cheerfulness in mind, how are we positioned? In short, we remain the most conservative, at the most conservative end of all of the strategy risk tolerance ranges that we manage. We are incrementally more negative on the economy, the stock market, and the stock market's that end. We have decreased cyclicality in the portfolio. Specifically, we decreased energy exposure over increased worries on where oil demand could be headed, particularly in a recessionary scenario. That said, earnings and guidance from companies for now is looking better than expected. And as you've heard me say before, while we don't love the broader market indices, we have found quite a few interesting individual investment opportunities. As for our mortgage REIT trade, which we've talked about over the last few months, well, we were a bit early. However, we think the conditions are now ripe for performance. Interest rates should stabilize, enabling these REITs to set effective hedges and collect very attractive mortgage-backed security spreads. Given all the macro issues I cited, maintaining a conservative posture is critical. And with bond yields at much more attractive levels than historically speaking, we don't have to take a lot of risk to get equity-like returns, given where these yields are. As a result, we have a higher return hurdle or threshold now to own stocks. And in short, we can wait out the economy and still make a nice return. So finally, let me touch on a few recent trades, and then we can get into questions. We have taken the opportunity to trim some of our biggest winners, specifically QTech, which is the equal-weighted NASDAQ. We put that trade on a number of months ago, and First Cash, which is a string of pawn shop stores in the U.S. and Latin America. We also added to our C Limited position to get even more Asian exposure. It's pretty clear that the Chinese consumer is recovering at a very fast clip. And just yesterday, or 2 days ago, we swapped out of our energy ETF, the XLE, and into another mortgage REIT, AGNC. So, I mean, you can tell from my message, we're trying very hard to be patient. We achieve this by being methodical and disciplined while we navigate this year of uncertainty. So with that, Keith, let's take some questions.
Sure. So we're going to just give a second and encourage everyone on the call to use the Q&A button at the bottom of the screen, and you can type in your questions. While we're waiting for people to ask a question, I do have a question. I thought I've read a couple of recently articles about the dollar. There were a couple of opinions about the dollar not being, or possibly in the future not being the world's currency. And of course, China was involved in that conversation. Is there any truth to that in your belief, thought?
We don't think there's any truth at all to that. It's, the global economy is basically rests on the dollar as its foundation. And if you stop and think about how trade is generally conducted, it's generally done by the dollar. And that means that not just is it the most convenient, safest way to currently transact, but that means that also the infrastructure for the global economy is based on the US dollar. So for example, all of the central banks are connected to the Fed and have dollar swap lines. So, and that's how they use, they regulate their currency and regulate their imbalances. So, there's just too many structural things that would have to be completely rewired for the dollar to stop being the, the sort of currency of the world. That being said, I think I think to some extent, Congress and probably a whole series of presidents have forgotten how important it is to to take care of your fiscal house and to ensure that the U.S. dollar remains that currency of choice. But at this point, there really doesn't seem to be any real movement on that front, despite some of the rhetoric that you hear.
Right. So we do have a couple questions coming in. Are the REITs that we own generally commercial or home mortgages?
Yeah, great question. So they're entirely agency mortgages. So these are Fannie Freddie initiated mortgages that are guaranteed by the federal government. So this is not part of the reason why we love these is that credit is not an issue. Credit would be an issue if we owned commercial mortgages, and so we've stayed away from that. We do own an ETF that has a little bit of commercial mortgage exposure, but as a percentage of any portfolio, it's infinitesimally small.
Right. What about precious metals in this environment?
Yeah, well, we own gold, a lot of gold, and it has been terrific. Clearly it has been a beneficiary of being a safe haven. Oddly, it didn't work as well last year, even though we had high inflation, but that has really, that underperformance has really caught up. And it's been a terrific class. You could theoretically own silver and basically get the same bump from that. And I'll touch on copper because actually somebody brought that up earlier to me today. We are a big fan of copper, but we have no exposure to it today. This is part of our clean energy theme that's in the portfolio, is that clearly there's going to be enormous long-term demand for copper, and you can't stand up a copper mine overnight. So that is an area where we've spent a lot of time looking. We haven't judged the timing to be just right on that, partly because of our concerns about the overall cyclicality issues. But it is something that we're focused on and we're watching very closely.
Interesting. Given that we're a global firm, investment management firm, are there any markets where you're more optimistic?
Yeah, so we love India, and we own an Indian bank in the portfolio. It's the fastest growing economy in the world, and it's got the fastest growing middle class. The credit metrics are amazing. I mean, it's basically a growth company, even though it's a stable, large, safe bank. The other areas that we're really focused on adding exposure recently to the portfolio is Asia broadly, as it benefits from China's, essentially coming out of its COVID lockdown. And specifically, we've targeted Indonesia and some of the Southeast Asian countries that we think offer enormous opportunities to grow as China recovers.
Very good. Well, that seems to be the end of all the questions. So having said that, I would like to thank everybody again for taking time out of your day to join us on this webinar, Market Strategy Update. We will see you again in, my goodness, it's already half the year, in June. So thank you, and we'll see you next time.
Thank you.